Okay, good afternoon, everyone. Welcome back to our options education series. My name is Tony Zhang. I'm the chief strategist here at Options Play, and today we're going to be talking about how to trade credit spreads like a pro. This is a very popular strategy. We touch up on this in bits and pieces in some of our other webinars, so I wanted to take some time out and actually dedicate an entire webinar to this very popular strategy for those of you that like to generate income. We do quite a few different webinars specifically on income generations. One of the more popular ones is cover calls. Sometimes we touch up on how you can utilize credit spreads as an alternative to selling cover calls or short puts without having to either own the stock or put up a lot of capital. So it's a great way to potentially get the same benefits as someone who's selling cover calls or cash secured puts without having to put up a large capital requirement in order to do so. So that's why this is one of the more popular strategies, especially amongst active traders to generate income. So today what I want to talk about is what are the best practices for using this type of strategy. Credit spreads, there's literally infinite number of ways you can utilize credit spreads. So I really want to touch up on kind of how you can go about quickly finding optimal spreads that make sense. I want to talk a little bit about the differences between different types of spreads, but we do have another video that we've done, webinar on debit versus credit spreads. So if you haven't watched that, I highly recommend after we're done here to take some time and actually view that video to understand what are the differences between credit spreads versus debit spreads, so that you can utilize the right one based on what your views are for the underlying market. The reason that credit spreads are really popular is because they can be used in pretty much all market conditions. Even though they technically are bullish and bearish strategies, a lot of times credit spreads are traded when you have a fairly neutral view on a stock. So you may not necessarily have to have a bullish or bearish view. You can still trade credit spreads, but I really want to show you guys, what type of signals you want to look for to enter a credit spread and how you want to manage that trade as you throughout the lifetime of that trade. So what we're going to go over is a few different things. I'm going to cover first of all, what are credit spreads, when you should consider using them, how to trade credit spreads effectively, and then we'll talk a little bit about how to manage these credit spreads, meaning how do you actually decide when to cut your losses or when to take profits on these types of trades. And then most importantly, what I want to do is spend some time on the Options Play platform, showing you how to find these trades, how to analyze them so that you can actually start trading them yourself if you've never traded them before, immediately right after this webinar. Now, I do have this webinar recorded, so for those of you that are brand new to this strategy or brand new to options trading, I highly recommend you take the time to watch the recording. The slides that I'm going to present today will also be included in that email, so make sure you download the slides as you watch that recording so you have all the information in front of you. I'm going to cover a lot of different materials here, everything from what a credit spread is, kind of how to select your expirations, the strike prices, and all that stuff. So there's going to be a lot of information. I don't expect you to all remember everything, so make sure you watch that recording and look at the slides. And for those of you that are interested in some of our other webinar recordings, so specifically the debit versus credit spreads, very important one to view if you're new to these types of strategies. I will include a slide with the links to our webinar recording and other important links, so that will be included in the slides that you receive from us. So let's go ahead and get started here. Let's talk about what are credit spreads. But before I do that, I want to ask a quick question for those of you that are in this webinar. Please, there's a poll that I just put up, and I want to understand, how do you utilize options in your trading today? Do you use it to generate income? Do you use it for speculation? And you can choose multiple ones. So please select the ones that most interest you when it comes to trading options. So far, it looks like almost 90% of you use options to generate income in some capacity. 50% of you say use it for speculation, and about 20% say use it for hedging or other, which is great because that's really what credit spreads are for. They're for both generating income and for speculation. So that seems to cover pretty much all of you here today, and I'm glad that we're doing this topic here today. and hopefully showing you guys how you can utilize credit spreads to generate some income for your portfolio. So let me just go ahead and share those results. As you can see, the whopping majority of you guys are using options in some way, shape, or form to generate income. Half of you are using it for speculation, and that's really what credit spreads is for. It's primarily for generating income and a little bit of speculation. So let's see how you can actually use credit spreads to do that. So spreads, very simply, are what are credit spreads? Very simply, they are two different types of spreads. You have a bull put spread for those of you that are looking for a bullish opportunity in the market, and a bearish spread, that's called a bear call spread, if you have a bearish view on the underlying stock or ETF. So how do you actually construct a bull put spread or a bear call spread? It's actually quite simple. Let's take a look at some examples here. So first of all, just to kind of explain what are credit spreads, these are vertical spreads that allow you to take a directional or mildly directional view with limited risk and reward. And in the example here, what I'm going to do is I'm going to use a theoretical stock, XYZ stock, trading at $100 just for illustrative purposes to show how to construct this. But actually, what I want to do is show you some real actual examples with some real ETFs and stocks to show you how you would actually analyze this using a real ETF or stock. So in this fictitious stock XYZ, trading at $100. If let's say you were bullish on stock XYZ, what you can do is you can trade a bull put vertical. And what a bull put vertical consists of is you're selling a near the money put, or let's say $100 put in this particular case. And let's say you sell this $100 put at $4. So what that means is you're bringing in a $4 credit to sell that $100 put. However, just by selling that $100 put and receiving that $4 credit means that you have to put up a substantial amount of margin in order to do so. Not to mention you have quote unquote unlimited risks to the downside. So one of the ways to both mitigate the amount of capital you need to put up to generate this income and to limit your risk is to simply buy a lower put, a $90 put. Maybe that put will cost you, let's say, $1. So that $90 put costs you $1. So you're bringing in $4. You're paying $1 to buy that $90 put. That brings your net credit to $3. So you're receiving a $3 credit by selling this put vertical. And that is your max reward. Your max reward is the credit that you receive on that specific spread. Your max risk is simply the distance between the two strikes. So we're selling the $100 put and we're buying the $90 put. So the distance between those two strikes is $10. So your max risk is simply the distance between those two strikes minus the max reward, or minus the credit that you're receiving. So your max risk would be the $7, the difference between the $10 width versus the $3 credit that you're receiving. So it's really actually simple to calculate your max reward, max risk on all credit spreads or debit spreads for that matter. It simply is the distance of the widths, a distance between the two strikes. Your max reward is the credit that you receive, and your max risk is the rest of that width. Okay, so that's how you actually construct a bull put vertical. Conversely, a bear call vertical is when you have a bearish view on stock XYZ that's trading at $100. What you can do is you can sell a $100 call, and let's say you sell this call for also $4, so you're bringing in a $4 credit. But if you were to sell this $100 call naked, then you have unlimited risk to the upside, and you have to put up a substantial amount of margin to do so. So instead, what you can do is you can at the same time buy a 110 call for, let's say, $1, only $1. And what that means is it brings your net credit again to a $3 net credit. And because the distance between the two calls is, again, $10, because the distance between a $100 call and a 110 call is $10, your max reward is calculated based on the net credit that you receive, which is $3. And your max risk is simply the rest of the distance between those two strikes. So again, a max risk of $7. So this is a very quick example of how you would actually construct a bull put vertical or a bear call vertical. Now, I know that I threw a lot of numbers out here at you, and I know that if you've never traded a credit spread or a spread before, that's actually quite confusing to try to figure out all these numbers. But the point of this is only simply just to show you how to construct them. The actual platform itself, Options Play, will actually construct it for you. So you don't have to memorize this. This is just for illustrative purposes for those of you that are interested in learning. Now, why do you want to trade these credit spreads? The simple reason is because selling credit spreads allow you to generate a consistent income stream. Because what you can do is you can sell one of these spreads for credit, and the goal here is to let that credit spread expire worthless, so you keep all of that credit or all of that reward that you've received. And what you want to do is you want to rinse and repeat. You want to do it over and over again, month after month, quarter after quarter, to generate a consistent income stream. So how do you actually go about doing that from a mechanical perspective, looking at some real stocks? So let's just talk a little bit about what are the best practices for credit spread strategies. So first of all, when we're talking about credit spreads, you can do them on pretty much any underlying, on a stock, an ETF, an index. You can do it on anything. However, it's generally recommended or general practice to use these types of credit spreads on ETFs and index options first before you consider using them on individual stocks. And the reason for this is because when you're trading a credit spread, you generally don't want the stock to move a lot. When the stock moves a lot, that's bad for a credit spread. And individual stocks simply have a higher probability of making big moves, because you can have a product announcement, you can have news announcement come out, you can have earnings, you can have lots of different things that can potentially impact an individual company severely, such as Netflix missing earnings, or Google getting hit by a $5 billion fine. These are all things that you can't predict that cause large jumps in these underlying stocks prices. However, with an ETF or index option, that happens less often, simply because an ETF or index by design diversifies that single stock risk away, so that no matter what single event happens to a single stock, its impact to the overall ETF or index is relatively small. So you generally don't have any jumps, and they're not susceptible as much to news and events like that, product launches. So that's why, generally speaking, credit spreads are better utilized on indexes and ETFs versus individual stocks. Next, once you've found an ETF or index that you want to sell a credit spread on, how do you choose your expirations and strike prices? Well, for expirations, it's actually pretty straightforward. Usually, credit spread strategies will usually do very short-dated options, anywhere from 2 to 5 weeks from expiration. And the reason that you typically choose short-dated options is because you really want to maximize theta, or time decay. So when you're selling a credit spread, time decay is working in your favor. And time decay really accelerates within the last couple of weeks, 3 weeks before expiration. So to capture that, you want to sell short-dated options to capture as much of that theta decay that happens as quickly as possible. If you sell a 3-month option, that option is going to decay much, much slower than an option that's only 3 weeks from expiration. So that's why you generally choose short-dated options. When it comes to strike prices, this is where credit spreads gets a little more difficult, because you literally have infinite number of possibilities of strikes that you can sell a credit spread on. You can sell far out of the money, you can sell near the money, you can sell credit spreads that are $1 wide, you can sell credit spreads that are $10 wide. There's an infinite number of combinations. So today, what I really want to do is talk about, on a general perspective, what are your different choices, and try to hone in on what are the best practices selecting strikes that makes the most sense. So when it comes to selecting strikes, first of all, you generally only want to sell out of the money strikes. You generally do not want to sell in the money strikes when it comes to a credit spread, because you're going to open yourself up to higher risks of early assignment, which will completely change the structure of this specific trades. By selling out of the money options, you have relatively low probability of your calls ever being exercised, calls or puts being exercised. So that's why you generally want to sell out of the money calls and puts. And when you sell, but the difference is you can select whether you want to sell near the money or far out of the money options. So when we're talking about selling near the money options, this is typically where you see a risk profile of what we consider lower probability of profit, but the trade-off is that you get better risk to reward. Conversely, you can also sell credit spreads that are really far out of the money, and what you're going to get is a higher probability of profit, but these trades will usually have a worse risk to reward. And this is a really important relationship to understand before we actually dig into before we dig into how to select your appropriate strikes for your credit spread. So in order to understand that, what I want to do is delve a little bit deeper into this concept, because with all trading, it's not related to just credit spreads. With all options trading, you're really looking at a relationship between probability and risk to reward. And this applies, again, to all forms of trading and all forms of options trading. You're really just trading off probability with risk to reward. If something has a high probability, that means it has a low risk to reward. If something has a high risk to reward, that means it has a low probability. So we talked about two different types of strategies that you can trade when you're trading credit spreads. You can sell near the money credit spreads, or you can trade far out in the money credit spreads. So let's take a look at this relationship of probability and risk to reward for these two different use cases. So when you're selling a near the money credit spread, like we said, you generally have a lower probability of profit. And what that typically looks like is you might sell a near the money credit spread, and you might see a probability of profit of maybe 67%, and then maybe a 33% of your trades are losers. So 2/3 of your trades are winners, a third of your trades are losers. And with these types of risk profiles, what you're going to see is risk reward that looks similar to this, where you have you're risking roughly about $200 to try to make around $100. So about a 1 to 2 risk to reward ratio. Conversely, you can also sell far out of the money credit spreads. And what these typically have is a much higher probability of profit. That you might see probability of profits of 90%, 95%, even 98% sometimes you can find. If you're looking at SPX or some of the indices that have far out of the money options that still have some premium in them, you can find 95, 98% probabilities of profit. And this is where I see a lot of people tend to gravitate towards, because people always assume high probability of profit means good. And that's not necessarily always the case, because high probability of profit always means very worse or very bad risk to reward. So you might see something like you might be risking $900 to try to make $100. And this is really where it doesn't really make a lot of sense. And because when you're selling that far out of the money option, you're collecting small amounts of premium and hoping that a large move doesn't happen. And granted, large moves generally don't happen very often, but as we have seen, historically speaking, these quote unquote black swan events where you get an extreme move in one direction or another happens more often than statistics implies that they will happen. So that's why, generally speaking, we do not like selling far out of the money options, because you're generally not getting enough premium to offset the risk that when the big move happens, and the big moves tend to happen a little bit more often than our statistical models tell us they're going to happen. And chances are the risk to reward do not compensate you enough for the risk that you're taking. So that's one of the things, the key thing to understand is that one is not better than the other. High probability is not better than low probability. Low probability is not better than high probability. The question is, how well balanced is this two? Okay. And that's really that was the question that we tried to answer here, is how do you actually select what is the right balance? And we searched for all different types of strategies. We did a lot of back testing on these types of strategies. And the general consensus for this type of strategy is to actually use the distance between the strikes as kind of your gauge. And the optimal strategy really is to try to receive roughly a third of the distance between the strikes. So what that means, we talked about the distance between the strikes is the difference between the long strike and the short strike. So if you have $100, if you sold the 100 call and you bought the 110 call, that's a width of $10. You want to collect a third of that width. So what that typically means is that you want to shoot for trades that roughly have about a 67% chance of winning. And you want to search for risk rewards that are roughly about 1 to 2, where you're risking about $200 to try to make $100. So what I have here is I just created a few different samples here of, because a lot of people like to sell different widths, and depending on whether you're trading a $5 stock or a $500 stock, you're going to trade different widths. So I just put together, a few different popular widths that you might trade: a $3 width, $5 width, $10 width, and the appropriate amounts of credits that you would be looking for to sell these types of credit spreads. So this is just a general rule of thumb. And the reason we created this rule of thumb is because everyone likes to trade different credit spreads. People like to trade near the money. Other people like to trade far out of the money. Some people like to trade wide ones. Some people like to trade narrow ones. There's no rule of thumb there. So the only way we can create some kind of best practice here is to use the distance between the strikes and try to always collect about a third of that distance in credit. That's going to let you know that you're getting enough premium for the risk that you're taking. So I understand this is somewhat conceptual. I want to show you some real examples using some real stocks so that this becomes more tangible for those of you that are new to this type of strategy. So now that we talked about, what a credit spread is, how to construct it, what are some of the best practices for selecting which expiration strike price, let's now talk about when should you actually deploy one of these strategies. Now, it's pretty simple. When you're selling credit spreads, you can use them pretty much all the time, right? You can use them pretty much whenever you expect a neutral or maybe a modest move in one direction or another. And one of the key differences between selling credit spreads versus debit spreads is that credit spreads, you can do them consistently on the same symbol over and over again. And I'll give you an example next to show you why that's the case. But credit spreads, generally speaking, are most optimal when you have overbought or oversold conditions. So meaning if you feel that the market is topped, that's a good time to sell a bear call spread. If you feel the market is oversold or hitting a bottom, that's when you want to sell a bull put spread. So these are the most ideal scenarios for you to consider entering a credit spread, is when you feel that the markets are kind of overbought or oversold and they've hit kind of a top or a bottom of a range. So traditionally, for those of you that are like to use technical analysis or chart patterns, a lot of times you identify a double top or a double bottom or triple top. These are the types of patterns and scenarios that you want to utilize a credit spread for. For those of you that like to use overbought, oversold indicators like RSI and MACD, I'm going to actually put up a poll here real quick. I'm curious to understand, how you generate your signals, buy or sell signals. Do you use technical analysis, do you use fundamental analysis, or do you use other forms of analysis? Because technical analysis is very, very, very popular with credit spread traders, because you can use them pretty much whenever you identify, however you identify bullish and bearish or overbought or oversold conditions, you can utilize credit spreads for your trading. Now, the one caveat to using credit spreads is that you should not use them when you expect a large move. So if you think the stock's going to move a lot, let's say earnings is coming up and you think the stock's going to beat on earnings or miss on earnings, or if you think that the stock's about to break out and move big in one direction or another, that's not the best case for use of a credit spread. For those types of trades, you want to use a debit spread, okay? Because credit spreads aren't going to allow you to take advantage of a big move. They only allow you to take advantage of a modest or neutral move on an underlying stock. So very important thing to understand. So 3/4 of you use technical analysis for your trading, and that's really where credit spreads are extremely useful, because for any of you that use technical analysis, you probably have some indicator that helps you identify oversold and overbought conditions or tops and bottoms. These are the times that you want to utilize those credit spreads. So lastly, just to reiterate again, when you feel that the markets are overbought or oversold and you're bullish on that underlying name, you want to sell a put credit spread. If you feel the market is topped or hit some kind of overbought condition, you want to sell a call credit spread. So I just have a visual kind of graph here just to show you guys, especially many of you said that you use technical analysis for your trading. So I just want to kind of highlight the difference between maybe a debit spread and a credit spread, right? So here, as you can see, I've identified this huge triangle. It's been in this triangle for a long time, and it's kind of reached this apex and finally started to break out. These are the types of trades that you would not necessarily want to use a credit spread for, because you're expecting a big move. In order to capture that big move, debit spreads are a much better use case for that type of trading. Conversely, when you have a more range-bound market where you simply feel that the markets are overbought or oversold, that's when you want to utilize your credit spreads. And the great thing about credit spreads is that as you can see here on this entire chart, I only have really one opportunity to trade a debit spread. On credit spreads, I can do them multiple times within a very short time frame. So this is where we talk about generating consistent income using credit spreads, because you can do them over and over again. So whenever you feel the markets are oversold, you can sell that put spread. And even if that put spread hasn't expired yet, you can sell another put spread if you feel that the market has kind of reached another point where it's oversold again. So you can continuously string these call and put spreads together. Even if one hasn't expired, you can continuously do them. And that's really where you start to generate this continuous income stream using credit spreads. And that's really why this is one of the more popular strategies, especially for those of you that are looking to generate income without having to put up a lot of margin in order to do so. So let's now talk about, once you're in a credit spread, how do you actually manage it? So we talked about entries are very simple. You time them with your expected entry tops and bottoms. So when you feel the markets are oversold, you might sell a call credit spread. When you feel the markets are overbought, you sell a put credit spread, and you can string these calls and puts together. So simple strategy on how to get in. Once you're in those trades, how do you manage them? This is really where it gets a little bit more complex when it comes to credit spreads versus debit spreads, but I want to make sure that we cover our bases here and show you guys how to calculate when to cut your losses and when to take profits. So when we're talking about taking profits, it's actually really simple for credit spreads, because the goal here is to let your credit spread expire worthless, which allows you to keep all of that credit. And the great thing about this strategy is that you don't really have to worry about taking profits. You just let your trades expire worthless. On Friday expiration, you don't have to do anything. If they expire worthless, you keep all your credits, and you can come back Monday morning and sell another one. So from the taking profit side, it's usually pretty straightforward. You just let it expire worthless, and that's it. When it comes to cutting losses, this is where it depends, because it depends on how far out of the money you're selling these credit spreads for. Like I said, when you're selling a far out of the money credit spread, you're going to receive a much smaller percentage of the distance of the width. When you're selling a near the money option, you're going to get much more of the distance between the width of the strikes. So when you're selling strikes when you're receiving more than 20% of the width of the vertical. So for example, in a $10 credit spread, or a credit spread that's $10 wide, if you're receiving at least $2 credit, like we said, we think that you should be about 33% of that. So as long as you're above 20%, a good time to cut your losses is if you've lost 75 to 100% of the credit that you received. So for example, if you receive a $2 credit on a $10 wide trade or $10 wide spread, then you want to cut your losses when you've lost when the trade's trading at about $3 to $4. So you sold it for $2 and now you have to buy it back for $3 or $4. So you've taken a $1 to $2 loss per contract. That's when you want to consider cutting your losses and getting out of that trade. You certainly don't want to hold it onto that trade to the point where you lose all $8. You want to have some point where you cut your losses. And that should be based on how much the spread is trading at with respect to how much credit that you've received. If you've sold a very far out of the money spread and you receive less than 20% of the width of the spread, that's when you want to give yourself a little bit more leeway, because you haven't received much premium to begin with. Chances are the spread is eating away into a lot of that already. So that's when you want to cut your losses, where you've lost about 1 to 200% of your trade. So if you've collected $1 on a $10 wide spread, then if that spread's trading at $2 or $3, that's when you want to consider cutting your losses. You certainly don't want to wait for it to risk where you're risking $7, $8, even $9 on that trade. So I highly recommend you to consider cutting your losses when you've lost 100 to 200% of the credit that you've received. So that's where, depending on where you sell your credit spreads, whether you sell an at the money, near the money, or out of the money, your strategy is going to differ. And there's so many different combinations that I can't possibly cover every single one and what to do in each one. So that's why we always use the percentage of the vertical width as a way to kind of normalize the fact that there's so many different possibilities. So keep that in mind when you're selling your credit spreads. So let's actually take a look at some real analytics on some real stocks to show you what it feels like to sell a credit spread or look at some credit spreads. So I have the Qs up here. So for those of you that are unfamiliar with the Qs, it is the ETF that tracks the NASDAQ 100 index. Many of you are familiar with the NASDAQ 100 index because it has the big names that you guys trade like Apple, Facebook, Google, Netflix, big tech stocks that are usually in the news are very the names that people are interested in these days. And it's a broad-based index, so that's why we generally like to sell credit spreads on it. And one of the things I want to do for those of you that like to use technical analysis, I want to add an indicator MACD, which is very popular amongst many options, many traders. And as you can see, MACD, the histogram, really started to turn over the last few days. So this is telling me that MACD on a MACD, the Qs look a little bit overbought here and starting to pull back a little. These are the types of conditions that you want to look for if you're trying to sell a bearish credit spread. Conversely, as you can see just a few days ago when MACD was kind of at this negative extreme and started to turn positive a little, that's usually a good time to consider selling that put spread right around here when it was trading around 170. And if we go back, we can see multiple scenarios. As you can see here on May 6th, when the histogram again peaked and started to turn lower, that was a time to consider selling a call credit spread. And as you can see, as you keep coming back, you can see how you can quickly string these along. So here on May 11th, as you can see, when MACD started to turn lower again, that would have been when it was trading at 170. That would have been a time to consider selling a credit spread again. And as you can see, that stock kind of just moved sideways for quite a few, about two weeks or almost 3 weeks since then. And as during that time, you would have been able to maximize your time decay during that time. Selling short dated options allow you to capture that time decay so that if the stock moves sideways, you're actually going to make a profit from that. So as you can see, if you just use MACD alone, you can see how many times over the last few months you would have been able to find overbought, oversold conditions and sell that credit spread. So right now, I've identified what I would consider overbought condition on the Qs, and it's starting to turn a little lower. So let's take a look at some credit spreads. So here, what I'm going to first do is I'm going to modify the strategy. We're going to use our strategy constructor. Like I said, you don't have to memorize how to construct any of these strategies. We do it for you. So let's click on bearish. And then what we're going to do is we're going to do a short call vertical, which is the call credit spread to trade if you're bearish on the trade. And what I'm going to do is first, I'm going to move the expirations to a shorter dated expiration. Like I said, we usually want to just go a few weeks out, so we can go, let's say, to the August expirations. And what I'm going to look at is I'm going to look at a spread with a $5 width. And this is just because it's easy to calculate the widths on $5 strikes. And I'm going to sell maybe a 180, so slightly out of the money, about $1 out of the money. And I'm going to buy a 185. And as you can see, that gets me a $2 credit on a $5 strike wide. So for me, that's actually a little bit more than 1/3. That's almost 2/5. So maybe I might move this out a little. So as you can see, if I move this out to the 181, 186, I'm getting about $1.70 on a $5 wide trade. That's exactly about 1/3. So if you remember from this slide before, if I'm selling a $5 strike, I want to collect roughly about $1.67 credit. That's going to give me 1/3 of the distance between the distance between those two strikes. And here I found a strike that gives me $1.70. So right there in that sweet spot. So as you can see, I have a probability of profit of 68%, which is, again, right in that sweet spot that I'm expecting, around 67% probability of winners with 33% losers. So this is exactly the type of strikes that I would be looking to do, slightly out of the money, collecting 1/3 of the distance of the width of the strikes. 181, 186, a $5 width. I'm collecting $1.70, giving that 68% chance of profit. So I'm risking $330, roughly double of what I'm potentially collecting on this trade. So what this allows me to do is now take a look at this trade. What I'm going to do is I'm going to go back to my P&L simulator. What I can also do is I can also first calculate the number of contracts that I want to trade. So as I can see, my max risk is 330. Maybe I want to risk $2,000 on this trade. So you can put in, I want to risk $2,000. That will tell you that you can sell 6 contracts of this call vertical. And what that allows me to do is go back to my P&L simulator and say, where do I think Qs are going to be, let's say a month from now on August 17th. So first of all, I might start with the current price, meaning I feel that that based on this MACD, it's not going to continue going much higher, but maybe it doesn't go much lower either, and it just kind of goes sideways, similar to what I saw here, right, where it was overbought, kind of came down, but it didn't really move any lower, it just kind of continued to trade sideways. Maybe I expect that same thing to happen. So what happens if the stock stays exactly where it is? I make that my $1,020 profit while risking roughly $2,000. So the 2-to-1 risk reward ratio, I'm risking $2,000, trying to make $1,000. And as long as the stock basically stays below 182.70, which is my break-even price, I'm going to collect that $1,020. So as you can see here, if the stock goes to 182.70, that's when this strategy breaks even. Anything below that is pure profit on this specific trade. Anything above that is where I'm starting to lose money. So as you can see, if the stock goes up to 187, I'm actually going to lose $2,000. So this is really where you get the 2-to-1 risk reward ratio. And as long as the Q stays where it is or moves slightly lower, you're going to be able to collect your $1,000 on this specific trade. So that's just a quick overview of how you would go about looking for one of these strikes. Like I said, this is by no means the only way you can trade them. You can trade a wider one, but the general rule of thumb, again, is that you want to select strikes both further out, near the money, but also wide enough where you're going to collect roughly a third of that width. That's going to give you the best return profile in the long run if you're interested in selling credit spreads. How many of you use RSI or MACD or any of these technical indicators in your trading? If you do, please type in the indicator that you actually use in the chat window. You can put in MACD, RSI, whatever it is. I'm interested in understanding kind of what type of technical indicators you guys are using for your trading. You can type them into the chat window. So I got a few RSIs, RSI, CCI. So in my, a MACD, in my opinion, these are all generally speaking the same. So it looks like many of you use RSI, MACD, stochastics. So that's pretty typical. And it really doesn't matter which one you use. They all kind of do the same thing. My general theory is that it doesn't matter which one you use. It's just a matter of using the same ones consistently. So I got a lot of different examples here, right? So stochastics, RSI, Chaikin, MACD, stochastics, relative strength. So again, many of these very similar, telling you very similar things. So William percent R, also very popular. So as you can see, I'm getting the similar type readings here, right? So when it was back here, when the MACD was overbought, this was also at kind of overbought conditions. So it really doesn't matter which one you use. My suggestion to you is just stick to the same one day in and day out, meaning don't use MACD today and then use stochastics tomorrow and RSI the day after. If you're going to use RSI, stick to RSI. If you're going to use MACD, stick to it, because what's more important is consistency rather than which indicator you use, because it's not like any one of these indicators is any better at telling you what's going to happen than the other. So just make sure you stay consistent, okay? So once you have one, and let's take a look at a different symbol. Let's look at emerging markets, because this is an interesting symbol in my opinion. A lot of action going on in emerging markets, especially with the news. So as you can see, emerging markets, for me, this certainly isn't a bearish trend. Recently kind of turned somewhat neutral in the 1-month trend, but the 6-month trend is still bearish. So for me, what I'm looking for is, this small rally is actually an interesting opportunity to get short. So here I'm going to look at EEM. I'm going to look at the same type of trade. I'm going to click on modify. I'm going to use our strategy constructor. I'm going to select bearish. I'm going to look at short call vertical again. Now, again, I'm going to move these expirations to maybe a slightly shorter dated expiration, like August 17th. And then what I'm going to do is I'm going to maybe look at maybe a $2 strike. I'm going to sell a out of the money. Let's say I'm looking at a 44.46. as you can see, a $2 strike, I would be looking to collect 66 cents because a third of a $2 strike is about 66 cents. And as you can see, I'm only getting 34 cents here. That tells me, hey, I'm not getting enough premium for the risk that I'm taking. So maybe I might adjust this a little. So let's say I take a look at maybe a $1 strike. Let's take a look at a $1 strike. I'm looking for roughly 33 cents. Here, I'm only getting 21 cents. Still not really what I'm looking for. So this is really where you're going to have to play around and see what you get. So here, as you can see, what I really have to do is sell it really close to the money strike in order to get this type of premium, right? So to sell a 43.5 call and buy a 44.5 call, that's a $1 width. I'm going to collect 34 cents, which is roughly a third. And so I'm really going to have to get really close to that money in order for me to get a third of the width. So this allows me, this is the type of rule of thumb that I'm typically looking for to help me find what is the optimal strikes to sell a credit spread for. So, and there's no good way to do this other than really playing around. And that's really why we created options play, so that you can quickly make the strikes wider, narrower, move them up one, down one, and immediately see what the reflection of what you're getting. And the reason for this is because if you've ever used a page like this, right, it's really difficult to select different widths, different strikes, move them up or down one, down one, and see what the net credit is with respect to different things, and then see the analytics behind each one. You end up doing a lot of guessing. So that's really why we created options play, so that I can quickly move all the strikes down one, up one, until I find the one that I'm looking for. So here I'm looking for, again, a third of the width. So I'm selling a $1 strike, or $1 width on this credit spread. I'm going to receive 34 cents, which is roughly a third of that width. And let's take a look at the P&L. Let's first say I want to risk, let's say $1,000 on this trade. So what I'm doing is I'm risking roughly $1,000 to make 510. My probability of profit is 60%, and this trade breaks even at 43.84. So as long as this, as emerging markets or EM stays below 43.84, then this strategy will be profitable at expiration, which is 29 days from now. So this is really where you can utilize this tool to say what happens if the stock stays where it is, or what happens if it stays where it is for a period of time. What happens if it stays where it is for just until August, let's say 5th. As you can see, it will calculate the expected P&L for each one of these trades, depending on what your different views are for the underlying stock. So the P&L simulator really allows you to see what your expected gains are as time goes by. So even if the stock stays exactly where it is, how much money do you actually expect to gain from theta? So this will actually show you that with respect. So as you can see, when you first start out, you're gaining very little amounts per day. So roughly 1-2% per day. As you get closer and closer to expiration, that number gets bigger and bigger. So as you see much bigger jumps. So as you get closer to expiration. So as you get close to expiration, as you can see, I go from 23% to 33% to 41% in a single day. So theta accelerates as you get closer and closer to expiration. That's really what you're trying to capture. So I even see people selling 2-week credit spread sometimes because they're really trying to maximize that theta. However, when you sell only a 2-week expiration, chances are you don't collect as much premium. So just keep that in mind. Even though that's really where you make your most, as you can see on the last day, it jumps from 63% to 100% gain. So almost a 33% gain in a single day, just on that very last day. So that's really why these trades, you want to hold them all the way to expiration, let them expire worthless before you go ahead and get out. Conversely, like I said, here I'm collecting a third of the width. So based on my rules here for cutting my losses, I'm collecting more than 20% of my vertical width. So I want to cut my losses if the trade has lost anywhere from 75 to 100% loss, right? So let's say halfway through this trade, the stock jumps up. Right. So this is where, this tells me, so if the stock goes up to roughly 44.30, which is about here, then that's where I'm going to lose roughly that 75%. So I'm going to lose $367 on the 510 that I've collected, or, you know, at 100% gain, you know, the stock needs to move roughly to 44.76 for me to lose my 510. So I'm lost 100% of the credit that I received. So this tool not only allows you to see where you would expect to take profit, or where, how much profit you would make depending on if the stock goes lower, if it stays where it is, but also gives you an idea as far as how far does the stock need to move before I have to cut my losses. And like I said, you usually want to cut your losses anywhere between 75 to 100% of the credit that you received if you're taking in a third of the width. If, let's say, you're selling a far out of the money spread, let's say you're selling one of these, something like this, where you have an 80% probability of profit, you're trying to make 105, but you're risking $1,400 to do so. That's really where, you know, you might want to take cut your losses, where you've lost maybe 200%. So again, 44.33, similar type moves against you, where you have to, you know, lose $200 even though you've only collected $100 premium. So you've lost twice the amount of premium that you've received. So this tool not only allows you to model where you would make your profits, but also where you should consider cutting your losses, or how far the stock needs to move before you have to cut your losses. Very, very important to understand these points before you get into a trade, so that you have this mental reference. Hey, if this stock goes up to 44.30, I got to cut my losses on this trade, so that you're prepared for this before you get in, and you don't just sell credit spreads and then figure this stuff out later. That's really the power of options play. We want you to know exactly what your potential profits are and what your potential risks are before you get into a trade, so that you plan for this properly and you're not surprised by this when it does, because trades go south all the time. You can't expect your trades to be profitable every single time. You have to be prepared for it. And the more prepared for it you are, the more likelihood you're going to follow through to your plan and say, I'm going to cut my losses because I already planned for this. And that's how you're going to be able to gain consistency in selling credit spreads for income. So with that, what I want to do is just open this up for Q&A. I just want to quickly reiterate, when you're selling these credit spreads, it's generally better to use them on ETFs and index options over individual stocks. You absolutely can do these for individual stocks. Just understand there's a slightly additional risk to doing that. You generally want to avoid doing these during earnings if you are doing them on individual stocks. Choose short-dated expirations, 2 to 5 weeks from expiration. Always choose out of the money strikes. And the rule of thumb here is the golden rule here is making sure that you receive roughly a third of the distance between the strikes on your credit spread. So with that, I'm going to open this up for Q&A. Like I said, for those of you that are viewing this, make sure that when you get the webinar recording, watch that recording, download the slides. If you haven't watched some of our other videos on generating income using covered calls or debit spreads, click on the webinar recordings link. That will take you to all of those videos. I highly recommend you to take a look at those. So with that, please, any questions that you have, type them into the chat window or the Q&A window, and I will answer as many questions as I have time for. The indicator below the chart is not labeled. What indicator is it? If you clicked on let's say a trade idea and you see this indicator, it will actually tell you right below it. It'll tell you what it is. So William %R is the indicator here. It'll tell you right below your chart. How do I set the indicators I choose as default? So currently we don't offer that. You have to set your indicators individually. Anthony's asking why not use weeklies. You absolutely can use weeklies, and that's exactly what I'm saying, is that you should use weeklies. The 2 to 5 week options is generally the sweet spot when you're selling cover calls. Selling credit spreads, right? So anywhere from this July, maybe this is not the right stock. Let's go back to QQQs. Sorry. On the Qs. So anything from August, in my opinion, 3rd to the 17th, all of these are valid expirations that you would want to potentially sell credit spreads for. So you absolutely should use the weeklies. These are probably the best use case for weeklies is selling credit spreads. What are your thoughts about using full stochastics to determine overbought and oversold? Chris, like I said, I really don't think which one you use is important. What I think is how consistently you use it. That's more important than anything else, because MACD, RSI, stochastics, they're all trying to measure the same thing. They're just slightly different calculations for how to do so. So don't use stochastics today and then RSI tomorrow, MACD the next day. Use the same one. If you're going to use full stochastics, use full stochastics every single time. That's how you're going to gain consistency. Can you please tell some indicators to determine which one is overbought and oversold? Like I said, there are so many of them out there. I'm not trying to tell you one's better than the other. They're all, in my opinion, the same. What's important is using the same one day in and day out and not switching it from one day to another. You know, I see some people will use a 14-day stochastics today and a 20-day RSI the next day and then a different MACD the day after. That's where you get inconsistencies. If you use the same indicator with the same period every single time, that's when you're going to get a lot more consistency in your trading. You know, I've worked with traders for the last 13 years in my career, and I will say the best ones are the ones that keep it simple. They're not the ones that use all different types of indicators and indicators of different time frames. They're the ones that stick to one or two that they really like and they feel confident with it, because then they're able to not second guess themselves all the time. We really suffer from information overload these days. There's so many different indicators to look at, so many news sources that we're getting our information from. Way more important for you to kind of help reduce that amount of information and be consistent in order for you to be profitable with these types of strategies. Then why are the daily play emails from Options Play buy options? Very, very good question. And I highly recommend you to view our webinar on differences between debit versus credit spreads, specifically on that. And this is really where, in my opinion, is I like to trade debit spreads myself because I'm able to get a much better risk reward on a debit spread. So for example, here on the Qs, right? Let's say I'm bearish on the Qs. I'm showing you a strategy here where you can sell this call vertical, right? So we looked at the, let's see, the August 17th, and I think I was selling the 181, 186, I think it was. Let's take a look at that. Yeah, 181, 186, which is roughly 1/3 the width of that $5 strike, right? So like I said, you know, I felt that the Qs were going to be rolling over a little. I think going down to 175 is certainly an easy target here. So let's say I think this is going to go down to 175. And let's put these two strategies side by side. Let's say I want to risk $2,500 on this. So I can sell 7 contracts of this call vertical, or I can buy 9 contracts of this debit spread. So one's a credit spread, one's a debit spread. So this is really where I started to take a look at these two strategies. And this is what I talk about in my other webinar between debit versus credit, is that even if I think there's a modest move in Qs lower, yeah, sure, you can sell this credit spread and make $1,100, but I much prefer trading this debit spread because, number one, I'm risking the same amount of money as I am on this credit spread. But as you can see on my credit spread, the most amount of money I can make is $1,100 versus on my debit spread, I can make $6,700. When, you know, Warren Buffett said this, you know, in stock trading, they don't call balls and strikes, meaning you don't have to swing at everything. You can wait for the optimal trade, right? So I find trades that I like, and I like the risk reward of debit spreads over credit spreads. I'm not a huge fan of risking more money than I'm actually potentially can make on a trade. So I much prefer that if I'm going to risk that $2,500, that if I'm right, I'm going to make a $1,700 profit on a debit spread versus only $1,100 profit on a credit spread. But like I said, these are two very, very different trades, right? Credit spreads are something that you can do over and over again on one single name, versus debit spreads allow you to really take advantage of a big move in any name. So I like to trade debit spreads on individual stocks because they tend to have big moves, and I'm able to capture that appropriately using debit spreads. Credit spreads is something that you just do when you have a modest or a neutral view, but you don't get paid for it if you do get that move in one direction or another. So it's not that one's better than the other. It really is dependent on what you prefer. And we just simply prefer finding these opportunities to really capture big moves and really make big profits from that. So that's a short answer to why we use buy options instead of selling options. What about defense rolling or converting to back ratio? So that's a much more complex, scenario and more individualized scenario. So I'm happy to answer some of those questions. If you email me at info@optionsplay.com, I'm happy to answer some of those questions. Let's see. On EEM, why is pop only 60% when the credit is 34 cents when pop should be 64%? So pop is calculated based on the implied volatility of the option and the break even of that price. So it has nothing to do with how much money you're collecting. Pop is calculated based on that break even price, and it depends on the implied volatility of the option. So that's why pop doesn't necessarily always have to match up exactly to what you've received in credits. How are you buying back when your short is hit? You just simply buy back the spread, right? So you're selling the spread to open, and when you're buying it back, it's a buy to close. If you have a question on how to close your orders, my best suggestion to you is actually calling your broker. They'll be able to help you out with that. What about converting spreads to condors or butterflies if they go against us? Great question. So when I talk about stringing calls and puts together, that's really converting, these spreads from spreads into butterflies and condors. So when we're talking about, so here, let's say I sold a credit spread here when it was trading at 103. I sold that call credit spread, and a few days later it went back to 101, and I sold the put credit spread. I may end up selling this call and put credit spread on the exact same expiration. Maybe this is, I went out 3 or 4 weeks. And what that does is you're basically legging yourself into effectively what is an iron condor. Now, this is exactly what I meant by stringing these together. You can string them together even if one hasn't expired, or even if you're selling another one, a put credit spread on a same expiration. You absolutely can do that. There's nothing wrong with doing that, Michael. Dan, regarding your question about first trade, I'm happy to answer that question. Why don't you send me an email at info@optionsplay.com. I've sent the link or my email address in the chat window. Please send me an email, and I'm happy to take a look at that one scenario for you. Explain the score. Ray is asking, explain the score. Ray, could you possibly elaborate on which score you're referring to? I'm happy to kind of help you out. If you're talking about the options play score, the options play score is a risk to reward metric telling you how good is the risk to reward weighted by the probability. So we talk about all options trading is a trade-off between probability and risk to reward. And what we see that most people tend to do is they only focus on one or the other. They're not looking at the two as a balance. So the options play score is really looking at how well balanced that risk to reward is to that probability. And the better balance it is, the higher that options play score. How about doing both a credit spread and a debit spread? You certainly can, but again, these are two very, very different trades. Credit spreads are when you think the stock's not really going to move, and debit spreads are when you think the stock's really going to move. So you have to decide which one of those two camps you're in, because that will help you decide which strategy you want to trade. You don't want to trade both, generally speaking. Peter's asking, isn't it more difficult to set the near strike to the current ETF index prices? It could quickly move against you, and you might not be able to react quickly to close the trade. No, not necessarily. Because like I said, well, this is really where you can utilize our tools to determine how far does the stock need to move before you trigger that stop loss. So here I'm collecting $1,100 premium. How much do I have to get to where I'm losing $2,000? Or let's say $1,100, right? So 1148. So here I'm losing about 100%. EM needs to move up to 186. I'm sorry, the Qs have to move up to 186 for that to happen. If that happens on, let's say August 1st, and the Qs are trading at 179. So we're talking about $7 move against you in order to get to that point of cutting your losses. So I don't generally think that selling an at the money is necessarily true that you don't have enough time to react. I think you have plenty of time to react if the stock goes up to 186. And this is really why having this P&L simulator is really, really important, because now you have this mental note before you enter the trade that if the Qs go up to 186, it's time for me to cut my losses. You don't have to figure that out at that time. You can know well ahead of time so that as you watch this trade age, and if the stock starts to pick up and goes a little higher, 183, 184, 185, you're already prepared that, hey, it's time to cut my losses. That's really why I encourage all of you to use our P&L simulator, not only for when you're making money, but also to plan for when to cut your losses. And by setting hard rules like this, that tell you cut your losses if you've reached 75 to 100% loss of the premium that you received. Now you know ahead of time before you even enter the trade when you expect to get out. So very, very important piece, Peter. Great question, but that's really how you can help plan for it, and it doesn't become a surprise to you. Barry asked, I learned to place the short side at the 10 delta. Your thoughts? I think I've already provided my thoughts, is that generally speaking, sure, you can sell a 10 delta call that gives you 90% winners, but you're risking, roughly sometimes $1,500 just to try to make $100. So you can do that, and 90% of the time you'll be great, but that 10% of the time, which tends to happen a little bit more often than statistics assumes, and that 10 delta is assuming normal probability, you're going to get hit very hard on those trades. So that's really why we always recommend selling a third of the width of the strike, not a tenth or a fifth of that. So keep that in mind. Let's see. Kamal's asking, MACD, can you please suggest ST day trade in SPX Amazon? Kamal, I'm really not following your question. If you could possibly reiterate that, that'd be great. How do you close out a losing trade? You simply enter a buy to close order. So you would simply sell to open to enter the trade, and you would buy to close to close that trade. Maureen, for questions regarding that, I highly recommend you to call your broker. They'd be able to help you and walk you through that process. Especially if it's your first time trading, I highly recommend ask your broker. They'll be able to help you out. Barry, absolutely. The slides are included in the recording. So I'll send everyone a recording about half an hour after we're done here. And in that will be a link to all the slides. I highly recommend you to take a look at the slides, especially for those of you that have not seen our debit versus credit webinar. The link to the webinar recordings will get you there. I highly recommend you to take a look at that. Peter's asking, for exiting an open spread trade, do you simply unwind your position, or would you consider taking the ETF to hedge risk? So Peter, taking the ETF to hedge risk is certainly one very advanced strategy, and that's what market makers do. They don't unwind their positions, they hedge their positions using ETFs. However, the problem with that is that your delta is constantly changing, so you have to constantly adjust how much stock you need to offset your risk. So I don't recommend you to do that. If you're paying commissions every single time you place your trade, you can only do that if, let's say, you can trade stocks commission free. I would generally recommend you to close out that trade in that particular instance. I meant a week before expiration to increase theta, if necessary, roll for more premium. So you can certainly sell 1 week options. You're just generally going to find that it's very difficult to find 1/3 of the width of the spread in a 1 week option, other than if you're selling pretty much an at the money call or a put. And generally speaking, that's not the type of strategy that you're looking for. That's why you want to go usually at least 2 weeks out when you're selling these types of credit spreads. What are popular ETFs and index ETFs for credit spread trading? The popular ones: SPY, QQQs, IWM, Russell, SPX, NDX. These types of are the ones that are typically traded. Tom, thank you very much. Go slow and show me how to access technical indicators on options play. So you simply click on the expand arrow here in the upper right-hand corner, and you'll be able to see studies. So again, click on the expand button here and click on studies. 33% premium. Use this for both credit and debit spreads? No, this is only for credit spreads. Only for credit spreads. Debit spreads is a whole different strategy. We're going to actually cover debit spreads next week. So that's why I broke this out into 2 separate webinars, because I used to do both of them in one. I highly recommend you to watch our webinar on that so that you understand the fundamental difference between the two. So this week we're covering credit spreads. Next week we're covering debit spreads. Kamal, I don't know what an ST day trade is, nor do I necessarily using 2-minute chart settings. I'm not sure. First of all, this is not a trade that you would make on a day trade, and nor is this a day trading platform. So I don't know if I'd be able to comment on a day trade per se. Rudolph is asking, we started talking about bull put spread, then bear call spread. Which is the credit spread and which is the debit spread? The bull put spread and the bear call spread are both credit spreads. None of these are debit spreads. We're only talking about credit spreads today. Next week, we're going to talk about debit spreads. Ray is asking, does the OP score have any kind of momentum factor? No, it has no directional bias. That's the whole point of the options play score. It takes no directional bias. It simply assumes that the stock can go up or go down with an equal probability, and tries to figure out what is the true risk reward of each one of these strategies. Kamal, we don't do 1 minute charts. We only do daily charts. But my point, again, is that it doesn't matter which MACD setting you use or which indicator you use. It only matters that you use it consistently. So if you don't want to use 12, 26, and 9, you want to use other settings, feel free to do that. Just stick to the same settings. Don't change the settings day to day or change your indicators from one day to the next. It really, in my opinion, doesn't matter which ones you use, because it's not like one is better than the other. If it was, everyone would be using it. SPX is like ES. Sure, SPX is the cash index, and ES is the futures on that cash index. So you can trade both in theory. If you have access to options on futures, you can certainly do that. But this is referring to equity indices that I'm talking about here. Does your website have a chat room? No, we do not have a chat room. We have these chats on these webinars, but we do not have a chat room. SPY is like day trading SPX. I'm not sure what that means, but one is an index and one is an ETF on the index. Frank's asking, do you enter orders net or enter separately? You always want to enter credit spread as a net, because you never want to be filled on one leg and left on the other legs unfilled. You always want to enter these as a single spread so that both legs get filled together. And if you want to exit, all legs get filled together as well. You never want to be left where you have one leg filled and the other one is unfilled. Raymond, thank you very, very much. I really hope that you guys have found this useful. I did this webinar because I got a lot of questions about credit spread. So I wanted to take the time and actually show you guys what are the best practices for trading these types of spreads. I know it's not my favorite strategy, but that doesn't mean that you can't trade them. Everyone has our own personal preferences. Some people like to generate income. Some people like to try to, hit home runs with debit spreads. Everyone's different, right? So this is really designed to educate everyone. So if you like to trade credit spreads, I hope you guys have found this information useful in understanding when to enter these credit spreads, what to look for when you're selling these credit spreads, and when to get out. And that's really the key thing here is consistency, right? Using these tools that you have available to you at Options Play to help you find the right strikes, know when to get out of the trade, when to cut your losses. And that's really one of the key things. A lot of people sell credit spreads and they have no idea when it's time to cut their losses. This tool allows you to plan ahead of time for that, so that you know exactly when to cut your losses, so that it doesn't become a surprise to you when the trade goes against you. You're already planned for it. You already know, hey, if the stock goes to this price, I gotta get out. So that allows you to be a lot less emotional in your trading. And that's really when we see people really get better at trading, is when they take the emotion out of their trading. Another good session looking forward to is debit. Yes, so we're looking at debit spreads next week, Ken. I'm dedicating an entire webinar next week to my favorite strategy, debit spreads. Again, please don't take that as that you should not trade credit spreads. I think credit spreads is a perfectly valid strategy for everyone. It's just a matter of personal preference. Is there a webinar on iron condors? Great question. I really think this webinar that I just did right now on credit spreads is the one on iron condors, because iron condors assumes that you think the stock's really not going to move. And that's almost never the case. There's no indicator in the world that I can think of that tells me that this stock's going to be exactly where it is 1 month from now. But credit spreads but you can trade iron condors by legging into two credit spreads. So for example, when the Qs right now are overbought, I'll sell this call credit spread, and maybe 2 weeks later when it's oversold, I'll sell that put credit spread. And what that combines into each other is that iron condor. But I don't really see, in my opinion, a reason to get into an iron condor, because an iron condor is really just a combination of these two legs together. But you really want to enter this trade when it's overbought, and you want to enter this trade when it's oversold. there's really no indicator that tells me, hey, this stock's going to stay exactly where it is and it's not going to move. And that's why I generally don't think it makes sense to enter an iron condor as a single strategy. It does make sense to enter them separately on each side. When it's overbought, sell that call credit spread. When it's oversold, sell that put credit spread. And you might end up with an iron condor, but I don't necessarily think it makes sense to enter it as one single strategy. Any other questions? This is certainly a long webinar, and I'm really happy that many of you guys had the chance to come out today and view this webinar. This webinar is recorded, like I said, with the slides, so I highly recommend you to take a look at those slides with the recording. I did cover a lot of things, and then there was actually maybe even a few things that I didn't get to cover, and I really want to make sure that everyone gets the chance to view all of these details using the recording. So please, any more questions? If not, I'm really looking forward to next week's webinar on trading debit spreads, showing you how to utilize debit spreads to really maximize your return when you have a true bullish or bearish view on an underlying stock. And it really takes all the things that we've built this platform to help you guys identify bullish and bearish views and helping you to be able to really take advantage of that using debit spreads. So really looking forward to that. Hoping to see all of you guys here next week. And I hope you guys all have a great afternoon. Thank you very much for joining me.